So in this video, I wanted to expand on what's going on in the Southern California real estate market. As far as this market's concerned, we're seeing quite a few different changes. Hi, this is Tom Olsewski with Coldwell Banker and Team Olsewski. It's my goal to provide you with the most accurate analysis of the Southern California real estate market. I want to get this information out so that people can make proper decisions based on what's really going on with the market and not hearsay, and looking at real economic model for housing and the United States macroeconomic outlook. So there's going to be a further housing shift, and we are seeing that today. We talked about the housing shift that was going to take place. We talked about it last year, what it would take. And when we talked about it again in February, when we saw that it was actually beginning to happen. We knew this crazy real estate market would not last forever. We saw that interest rates were going to rise. We understood what happens when we get a rise in rates, like we did back in 2013 and 2018. There is a change in the marketplace. We get demand that comes down and the inventory that rises, and as a result, market times rise as well. You can see what happened in 2013. That's the green dotted line, and what happened as far as the inventory is concerned. That is the green solid line we haven't seen even made up for all of Southern California back to 2013 levels. 2013 levels was the lowest level that we had seen since 2004, and we haven't even made it up to that level. That's how low our inventory was, so we're coming out of the basement. The dotted yellow line is mortgage rates so far this year. We're seeing this rise in interest rates to a little bit above 6%. Matter of fact, it was at 6.28% a couple of days ago, and then since it's fallen back towards 6%. Now this is exactly what we're seeing right now. We're seeing that jump in interest rates, and so as a result, we're going to see a shift of what we talked about will even be more exaggerated. I'll tell you what that means. So what in the world is going on? Well, it was the Consumer Price Index report that came out last Friday. As a result, as this report hit, all of a sudden, Wall Street tanked. If you have any stock investments, you saw this firsthand. Not fun to see, not at all. With that news, the 10-year Treasury jumped, and so did mortgage rates. Mortgage rates are tied to the 10-year Treasury, not directly to the Fed's interest rates. Interest rates jumped pretty far, and then Monday they jumped even further. So this was a lot hotter than what the economists had expected across the board. All economists did not really see this one coming, but there's some economists that did listen to these inflation reads, and they're going to be sticky high, and they might even go higher, and certainly enough, that is exactly what happened. Headline inflation numbers at 8.6%, and that's the highest level since, of course, 1981, where we got inflation all the way back then of upwards of 14. The interest rate is at 6%, so it actually came down a tiny bit, but at the end of the day, it doesn't matter. All that inflation takes into consideration includes food and volatile gasoline. But when you put it all together, everything does not look that hot as far as inflation is concerned. So as a result, we got this giant spike up in the interest rates really fast. It was an enormous spike, and if you could see it right here, if I draw a line across the 6.05% as of today, and that is the highest level since November of 2008. They tried to show you with this gold line on the left-hand side, it's the largest rise since 1981. You can see this is the yearly highest rise for all markets since 2011. That gold line, that's going off the page. That's because we're at 1.9% of a change. And so that means it's a 0.9%. So this change in our interest rate so far is like off the charts. And if you compare that to all other years since 2011, and we have not really experienced anything like this. It's the largest rise since 1981. And as a matter of fact, it's the record year-to-date increase in mortgage rates. And this comes from Freddie Mac since they started tracking this back in 1971. So in 1981, they did go higher, and it was later on in the year that it continued to go even higher. That's the gold line you can see on the chart. This is 2022, and that's where we're at right now. To the left of that was 1980. So it did go really high in 1980, but then came way down. That gold line is the methodical rise over time, and you could see that it actually rose higher, but who knows where we will be later on. The experts have somewhat of an idea, and their ideas are we're going to see interest rates that are going to be between 5 and 6.5%, and that's the new area that they're going to fall unless they get another read that shows us something different. So as the experts are not like forecasting exactly where interest rates are going to be, because not even the Fed, nobody can really do it, because we can extrapolate out as to what the inflation reads and other indexes are going to read down the road. And so this is that 1981. So the Fed issues the most aggressive rate hike since 1994, and you can see where it's at right here on the right hand side now. We're already at 1.75%. We were at the floor earlier in this year prior to March, and this thing is going to climb all the way up to what consensus is about 3.5% is where the short-term rate is going to go, and that's where I'm pointing to the right there. Then in 2023 it's going to go up again to about 3.75 is what consensus is, and then 2024 come back down to 3.5%. But we don't know exactly what this is. Right now is where you need to be for the markets to behave the way that the Fed wants it to behave, and that's where it's not too hot, but it's just right, kind of like Goldilocks. And it's where we get inflation under control, and this is where they think they need to be, and inflation is the biggest concern. That target range as to where everything will be panning out a lot better. Now this is all from Len Kiefer and Reports on Housing, gets this stuff off Twitter. What they want to show you is right here we're at 2.21% change in the interest rate year over year. So that is a gigantic difference from last year to this year. Now the last time this 12-month change in rate and percentage points happened, it was similar to this in 1994, but 1994 that's at 2.05% year over year. You've got to go back all the way to 1982 when it was 2.22% difference year over year. So you have to go way back in time. The last time that we saw this kind of a shift year over year. So just wanted to point this out. This is such a gigantic shift for this year, and comparing it even to where we were last year, that it's enough where the Federal Reserve has stepped in now. They don't usually put quotes and read all this stuff, but I think it's very important for everybody to understand that this is what Bernanke said it was. Actually, the last question he took in the Q&A, and what he said is the following: rates were very low, and now they're coming back up to more normal or above levels. And then he said, so we saw prices, he's talking about housing, moving up very, very strongly for the last couple of years. So that changes now, is what he's saying, and this is their mandate. I really think that they really want to slow housing. It's one of those pieces that they want to slow so that we can see rents low, and that's part of the whole inflation mix they are trying to control. He also said if you are a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together and where inflation is down low again and mortgage rates are low again. So he's prognosticating that down the road that we can get back towards a more of a balance so that interest rates can then fall again. But exactly when that's going to happen, they don't know. They wouldn't bet within the next few years, but this is a long-term goal that they're talking about, which is good news. This will be a process, they say, whereby ideally do our work in a way where the housing market settles in a new place. But now rates are rising. Rates have been rising, and now they did this giant spike since Friday. And so when rates rise, we get this drop in demand. We get this increase in supply, and we get this increase in market time, and demand right now has been coming down, and the main culprit is the fact that the pain is just with the affordability. This is nationally. This is done by Black Knight, and nationally this is as of last month's interest rates. This is going to be far different when we factor in these interest rates. They started doing that for all of Southern California, and it's off the charts. Like Orange County, they've never seen it so lopsided. LA County, it was looking okay, and now it is as bad as it was during the Great Recession as far as affordability is concerned. But don't get ahead of yourselves. Don't think that we're going to all of a sudden implode and this is going to be the Great Recession all over again. They keep on hearing different pundits and different people on the financial side of things continuously talk about the fact that they think that the market is going to implode and it's going to be just like 2008 time period. And that's just absolutely ridiculous. Couldn't be more false. And if you draw a line across, you can see that the national payment to income ratio, which is how much of your monthly mortgage payments are devoted to exhausting the mortgage debt, it's been rising like crazy. And with this recent last few days, it rose even further with the rates going up. So that it puts us all the way back to a long time ago. We can show you so at the beginning of the year if you were looking for a $4,000 per month desired monthly mortgage payment, you were looking at 3.25%. $1,021,000 house is what you could afford. Now just today we're looking at a $741,000 house for that same principal and interest payment after putting 10% down. $4,000 per month. So that's $741,000 versus $1,021,000. You can see what happens if rates continue to go up towards 6.5%. which they think they're going to bounce right around where they're at right now. because we actually saw, matter of fact, when the short-term rate went up 0.75% yesterday, mortgage rates actually fell from 6.8% down to 6.05%. So even though they announced that, the market liked what they heard, and they went back into buying 10-year treasuries and buying mortgage-backed securities. So it brought mortgage rates back down. But you can see this is a big change in affordability. How about a payment on a $1 million home with 10% down payment? At the beginning of the year, you're looking at $3,917 per month, and right now you're looking at $5,396 per month for the exact same payment on a $1 million home with 10% down. That's a $900,000 loan that we're talking about. You can see that's a big shift, a big change, and so as a result, last year, this is what we were dealing with. Just a pool of buyers. Interest rates were really good, so demand was up. And we're getting multiple offers on properties. Everybody couldn't find a home because there were not enough homes on the market to sell, both on the resale side and the new home sale side as well. But as interest rates started to rise, you could see that pool starts to shrink. And then when rates spike even further, like they had right now, that pool shrinks even further. So the number of potential buyers that can afford certain ranges in certain houses just diminishes. And it diminishes more as interest rates go up. So as a result, fewer people will be willing to buy homes. That is a given. And I want everybody to understand that. And you can see that in the demand last Thursday, June 9th, 14,096 was where the demand was at. That's a snapshot of 30 days worth of new contracts. So they look at the same 30 days of new contracts because I could see when all of a sudden there's a change, it'll show in the data really fast prior to people looking at closed sales and different things like that. So this actually shows real quick the changes in the market. And we'll see what's happened so far through today. But this was down 5% in a 2-week period, or down 808 pending sales. Last year at this time, we were at 19,679, 40% higher than where we are today. But that was a record year. And the 3-year average prior to COVID, 2017, 18, and 19, was 25% higher. Now that means that we are dealing with muted demand. That's that yellow line. But be careful. Yes, we have muted demand, but it's matched up against muted inventory. So that's why the market still feels pretty good out there. It's not hot like it was a year ago, but still pretty good because of the fact that this muted demand that might be the lowest in a long time. However, it is still matched up against not enough homes still on the market. It's changing, but it's still low today, and we're at 13,965. It only went down 1%. It was not a big shift from last Thursday to this Thursday, but it's going to take a while to absorb these new rates. As a matter of fact, the way that they think it's going to go over the next couple of weeks is we're going to see the demand continue to fall, so the number of escrows continue to fall, and then it will find a new plateau and a new playing field, and it's going to then go steady for a while until we get right around Thanksgiving, where we get to the holidays, and it falls from there on our yearly holiday slowdown. That's normal. Now on the supply side of things, supply increases. So we said demand falls when rates rise, supply increases, and it increases because these people right here, There's so many homeowners that think that the market's going to behave like it did in 2020 and 2021. They wonder why they don't have an offer after a week, 1 week, 2 weeks, or week 3. I've got a home that's across the street from where I'm at today, and it's been on the market for I think 5 weeks. It's had 4 out of 5 weekends straight of open houses, and I'm pretty sure that the property is overpriced. I went through it. It looks really nice, especially now because they painted and they put new carpet in to make it look nicer. But we're going to build the inventory in the backs of homes that need a lot of work. They just need a lot of work. Homes like this got away with selling during the 2020 and 2021 markets when there's nothing on the market and people were buying anything. They actually got more than the last comp, even though they needed a lot of work. So there weren't a lot of homes that sat on the market for a long time during this time period. So you could sell a property that needed work in that kind of environment. But you can't in this environment. They have to be priced below the last comp that is comparable but was in good condition. So that is a recipe for getting a home sold. You no longer can overprice properties that say back up to busy streets. Also, those will go for less now than in 2020 and 2021. They went for more back then, but now today they need to be priced less than the interior properties. You can see those properties that back right up to the freeway right there. The ones that are further in on the interior of the track will be different. If there is 2 homes that were at the exact same price and you're going to buy the one that's more in the interior, not the one that backs up to the freeway. So with more product that's available, those properties that are in inferior locations need to be priced accordingly. And then we just have houses that are a really good looking house, but they priced it over the fair market value. As a seller, you really need to hone in on exactly what the fair market value is and be extremely careful not to overprice. And you can see that this is happening because we actually have many price reductions. So I'm giving you the updated price reduction statistics, but it goes between 25% of all the way up to 28%, and San Bernardino and Riverside are actually at 30% of all the entire housing stock that's available today have actually reduced their price. And that's because of the overpriced thing I just talked about. And as of last Thursday, we were up at 23,217, and that was 11% or 2,390 homes in a 2-week period of time. And that was the largest rise of the year for a 2-week period of time, and it's the highest level since November of 2020. So we're getting higher and higher as far as inventory, and that's the green line. As the market continues to go up, it's going to go further into 2020 and make our way back to hopefully back towards 2019. And they say that's because hopefully that's where there'll be a better balance in the market, and that's what we're looking for. And that's exactly what the Fed's looking for. And they think that we can all agree everybody's asked for more homes on the market. Well, we're finally getting more homes on the market. Last year at this time, we were at 17,631, which is 24% less. We have more homes on the market than the prior year for the first time since 2019. And then the 3-year average is just about 40,000 homes. So we're 23,000, that was as of last Thursday. So we're making our way back towards 40,000, which is 71% more. Just within the last week, we've gone up 24,278, which is another 5%. So we're making our way slowly but surely each week. There are more homes. it's been going up like at least 1,000. So it looks like we'll get towards that 3-year average or prior to the pandemic, but they do want to caution that there is something that's going on. Homeowners aren't necessarily moving. If you compare the number of homes on the market to the 3-year average, they've talked about this before. In 2020, we were missing 24,000 homes. In 2021, we were missing just about 20,000 homes. And in January to May of this year, we're missing another 18,000 homes. So within the first 5 months, we're missing so many homes, it's almost at all the homes that we missed in 2021. We have been putting a muted number of homes on the market. You can understand 2020. That was the first COVID year. Last year, we were still dealing with COVID. So people changed their housing habits, and they've been staying put, and they're really staying put this time. And this is the new trend that's developed, and that's because people are in love with not necessarily the home, but they're in love with their loan, and you could see it in this happy couple. They're not moving. If you look at a couple that purchased a home in 2015, say for $665,000 with a 3% loan, they refinanced to, because just about everybody refinanced under the sun, and they actually have these real life examples that this is taken from. So if the principal, interest, and taxes is $3,133 per month now, if they sell today, which in this example actually did, and they actually sold a couple of months ago, they sold for $1 million. And their net was $380,000. Now, let's see, what do I do? Should I really purchase now? If you looked at principal and interest of $3,133 and you wanted to purchase a $1.2 million home, well, right now today you're looking at a principal and interest and taxes of $6,043 per month, and that is an extra $2,910 per month. So that's the payment at $6,043 versus $3,133, and they're only going up $200,000. Excuse me, $200,000, and that is a difference of $2,910 per month. So the problem is this: if you went and purchased a $1.2 million purchase, they were looking at purchasing, and if they had sold their house and bought January 1st, they would have been looking at a difference of only $1,424 per month, or $17,000 per year. Now remember, they purchased back in 2005. This is 7 years later. You know what they can afford to do. That is their thinking. However, if they purchase today, they're looking at $2,910 per month for that $1.2 million purchase. So it went from $1,424 per month, a difference to $2,910 per month, and $17,000 per year to $35,000 per year. What that's doing is fewer homeowners are going to be willing to sell, and when they do, the math period, that's going to be the new trend, and you could see it in the inventory. So what's going to happen with the inventory, even though fewer people are coming on the market? There's a lot of stuff that's not being absorbed because they're overpriced. Say they back to a busy street, or they have airplane noise, or they need a lot of work done. And as a result, we're going to see this inventory continue to grow at a very fast pitch until we get to the end of summer. And then it will continue to grow, just not at the same rate. And then we will peak between October and Thanksgiving. And when we do that, we will have more homes on the market than 2020. This has been revised, and it's now going to be a lot more homes on the market than 2019 actually, and that's that purple line. So we're right now dealing with this red line that is 2021, the green line here is 2020, and this purple line up here is 2019, and we're going to surpass that. So we're going to surpass levels that we haven't seen since prior to COVID. So let's get right into market time. And here we are, what is the expected market time will be. So this is if you place your home on the market to when you are going to have a contract and then open up escrow. So you can close another 30 to 45 days down the road. On March 17th, we were at 24-day expected market time. Well, last Thursday it had ballooned to 49 days overall. It went up a week in 2-week period of time. So it was at 42 days 2 weeks prior, and now it's at 49 last Thursday. And last year at this time, it was at 27 days. And as of today, taking into consideration the supply and demand that was just quoted, the 3-year average is at 68 days. Today, days on the market went from 49 to 52 days. So it's making its way towards a slight seller's market. Once it gets above 60, it is no longer a hot seller's market. Now you really have to be careful on pricing. You have to scrutinize it like crazy. There's no wiggle room. And the same thing with the balanced market, which is above 90 days. Now I'll talk to you about how county markets are doing. Los Angeles County went from 30 to 55 days, so they're knocking on the door of a slight seller's market. Orange County's from 20 to 48 days, so they have some time before they get there. Riverside County went from 21 to 50 days, so they're getting a little bit closer. San Bernardino, 28 to 64 days. This is the first county to be a slight seller's market. They are no longer a hot seller's market as of today. Then San Diego County went from 18 to 42 days expected market time, so they have a long time to go. And Ventura went from 20 to 52 days. And by the way, timing I'm saying here, we're talking about March 31st to where we are today. So a big shift in the market time from March to today. So much hotter, insane market to a much more methodical market, which means you've got to be careful in pricing in this market. So we seem to be moving towards a balanced market that's between 90 and 120 days on the market. So anywhere from 3 to 4 months, it's actually an equilibrium and it's balanced where buyers and sellers have to figure out, like grown-up adults, and kind of come to an agreement. Sellers don't get to call the shots. Buyers don't get to call the shots. You kind of have to figure things out so both parties are happy. But they are starting to see the ability for all of Southern California to get towards a slight buyer's market, and that is above 4 months. Now people ask me all the time, well, so when do you get prices that come down? Well, prices usually have to be above the 4-month threshold with duration, and that duration is anywhere from 4 to 6 months before we start to see any kind of a decrease. So we are definitely nowhere near this, and as I'm seeing some buyers thinking it's time for big discounts, it's not today. This is not the market. When we do reach that point where we might see discounts in values, and again, we're not talking giant discounts like 2008. They're talking like maybe down 3%, maybe 5%, just single digits. It's not a bubble. You can't compare this to the Great Recession. It's not the same thing at all. The fundamentals are completely different, as there was a bunch of junk that was done prior. It was real loosey-goosey, easy to get mortgages, and then compare that today, and it's very tight. You have to qualify. People have to have good credit. It's not like it was back in 2008. There's not going to be a bunch of people who are going to panic. They're just not going to move. They have good credit, they have good jobs, they have money in the bank, and they have a lot of equity and a nice low payment. Why are they going to move and go rent something when rents are continuing to go up? Because now you got a lot of people that aren't purchasing. Where are they going to go? They have to go rent. So that's just putting more pressure on already a really hard market to get into rentals. And that is because millennials are going and purchasing. They're getting married, and they're not going to want to live with mom and dad, and they're not going to want to live with a bunch of roommates either. There's not going to be a crash in the marketplace. There's not going to be an upside down homes with short sales, as it doesn't exist. We're at the lowest delinquency rate since tracking began in the 90s. So that's not happening, and it's not going to be a wave of foreclosures. It's just not going to happen. The data doesn't show that. So that's it for this very detailed housing report for Southern California. The information contained in this report has been obtained from Reports on Housing, a very trusted Southern California housing analyst. And again, thanks for watching, and remember, it's important who you work with.